Hey everyone, Douglas here, kind of market analysis, and yeah, it's been a while since I've done a more macro-themed update for the YouTube channel, so I thought, why not jump on and yeah, kind of talk macro. And what I thought I'd talk about tonight is really where I think the bears have gone wrong. Heading into the summer months, bear sentiment was really through the roof, and I think a lot of people were anticipating an eventual rollover of the market. And since then, we've absolutely taken off into really uncharted territory, week in and week out, making new highs to where we're at now. As it would happen, I meant to kind of get this, or not meant to, but my plan was to possibly get this video recorded during the weekend when we were off of fresh new all-time highs to close the week out. And as it were, I waited till today, off of a nearly percent sell-off in the S&P, and so I was going to name this kind of where the bears went wrong or something like that, but maybe I might change the title to that the bears have a hope or something. But the general theme that I do want to get across is I want to talk about kind of some ideas that I saw that I think the bears really clinged on to again during those summer months that I think were very misguided and ultimately proved just incorrect again as we broke out as I thought we would. That's very much been my thesis for some time now, that I still think we're in a very bullish market that was kind of destined to go higher as we've seen. And I still think even after today, I'm sure it might take a few more days for this sell-off to kind of settle down, and we might push a little bit lower. But I do think likely by the end of the year, we will see new all-time highs once again as we rally into the end of the year. I still think everything's set up for that. So yeah, I mean, there's kind of where I'm at with that. But again, the focus of this video is to really look at a handful of risks that I think the bears very much bit into too much and very much kind of oversold on, if you will, in terms of the market. So let's just dive into it, and we will we'll kind of go from there. So the first risk that I kind of think that the bears really misunderstood is the yield curve inversion. And by risk, I mean I think many bears thought that the yield curve inversion was a kind of a surefire signal that the economy was signaling, or that markets were signaling, particularly bond markets were signaling that future growth was all but absent, and that is kind of the classic definition or classic understanding of yield curve inversion. And so I think that was a signal to many that we were seeing not only kind of future growth being discounted quite a lot, but on top of that, maybe some issues with regard to what's happening in the money markets and kind of the confluence of factors that we saw come together, say in 2008 or something like that, that took the market out as well in terms of liquidity squeezes or that sort of thing. But I really think that, and I think it's played out since then, that what we saw happen through the summer months into September, into August, September, in terms of the Fed having to step in, I really think it was just a big misunderstanding, particularly again from a more bearish standpoint of exactly how particularly the repo markets work and what the Fed's role is in the repo market, and what led to this point in terms of the Fed finally having to step in, and that was really the driver of the bond markets and the yields themselves in the short run, again particularly thinking during this time frame, midsummer into the late summer months. Nathan Tinkus of the Money Network, Modern Money Network, had a great write-up on Twitter on this, and I will link to that in the description below. There's multiple tweets that he put out, but to kind of sum it up, I think he did a great job in explaining this in just a handful of tweets. But to really sum it up, it was really Basel III that over the last decade kind of finally reared its head, and the regulations that Basel III, the constraints that Basel III has put on the banking system in terms of the regulatory requirement for reserves, that really caused the issues that we saw over the summer that made the Federal Reserve step in and become kind of the lender of last resort once again. And that was something that I don't think the Federal Reserve fully understood. And this is not to be a Federal Reserve apologist or anything like that, but it was just the reality of the situation. It wasn't that the economy was in dire need or anything like that, that it was on its last leg and the Fed stepped in. It's that circumstances that hadn't been seen for a decade reared their head again, and they weren't circumstances of true liquidity. It was circumstances of kind of competing regulatory frameworks that finally caught up to the banking system, and the Fed had to kind of realize its position and role in this. And if anything, the criticism is that the Fed just has such a poor understanding of the money system as a whole. Especially this Fed right now seems to have a very poor understanding of kind of what the banking system is, and they were very much behind the eight ball, if you will, in terms of what the functions that they needed to provide for the market were. So again, I think it was really just a big overreaction to kind of some technical processes that were not fully understood by the Fed, and the Fed came in last minute, far too late. None of it had to happen had the Fed really understood what their role was. None of this would have happened, and we would have never seen a yield curve inversion at this point. So as it stands, I think the bears who really saw this as, okay, recession's imminent, we're seeing this, we're seeing tightening in credit markets, that sort of thing, all converge into the summer of 2019, late summer of 19, who really bid on that and thought that this was when things were going to roll over, that they were obviously on the wrong side of that trade and kind of sorely misunderstood the situation at that time. So again, I'll link the full readout from all the tweets that Nathan Tank has posted and give you a little bit better understanding. But I think that was really the cause behind the inversion of the yield curve, and we're much more likely, if anything, I don't necessarily think for certain that we're maybe 2 years out from a recession, but if anything, this feels a lot more like, say, late 1998 than it does, say, even 2000 or 2007, where we get kind of our first issues emerging, and then we rally on for a few years before we turn back over. But as it stands right now, at least where we're at, I think the overall situation does not remain, or is not in any way bearish or presenting a bearish scenario as it stands. So that was kind of, again, the first risk, if you will, that I think was kind of oversold by the bears. Next up, in terms of different ideas that I think I saw just, again, presented out there, and this is just from what I saw from my Twitter feed, from my news feeds, the sort of things I pay attention to, and I like to listen to mostly people who take opposite sides than me, because it kind of strengthens and sharpens my own thought process. So this is just, again, my anecdotal assessment of everything that I saw out there in the market. The next thing is kind of an overreaction to faltering global economic indicators. And one of those I'm just going to pull up here is and I can kind of zoom in on this to make it hopefully a little bit larger on your screen. One of these is going to be the Euro area manufacturing PMI. So this is just taking the aggregate of the Euro area. Obviously, it's going to be very heavily weighted towards Germany and France being the two largest economies in the Euro area. But effectively, the manufacturing PMI of the Eurozone went and still is in major contraction area for the Eurozone. Anything below 40 means that manufacturing is contracting, and that's generally an indication of a recession being imminent. And the reason I bring this up is this definitely was devastating for the Euro area. We'll see in just a second. Bring up a chart. But in terms of kind of the global economic recession and a lot of the interviews that I listen to, or a lot of the, just kind of the sentiment that I get out there, a lot of people keep throwing around 2008, 2007, and a lot of people keep throwing around 1927, 1928, 1929 timeframes as well. And so, I mean, the call here seems to be that something big is brewing. And one of those pieces to that puzzle was, look, we're seeing Europe and we're seeing the rest of the world for that matter. Again, this is just kind of one indicator of many that we did see from global weakness. But here's the thing is, and this is not some sort of, what I'm about to say is not to say that the U.S. is in any way superior or anything like that. It's just a function of the reality of the system that is in place. But the U.S. economy, one, is kind of the black backbone to the global economy, and two, the U.S. economy, by virtue of the U.S. being the creator of the dollar through fiscal spending, is in a much different position than the rest of the world. So I think you can really overbite, if you will, on slowdown in the rest of the world, and think that and correlate that to a necessary U.S. slowdown when that's not necessarily the case. There are different factors in play in the U.S. than there are in the rest of the world, again, because the U.S. is this sovereign creator of the U.S. dollar, and on top of that, the fiscal flows have been very strong in the U.S., which will be my hint to foreshadow the third thing that we're going to talk about. But going back to the poor data as a whole, and the divergence that we've seen from say Europe and the U.S. over the last decade, I want to show that and hopefully kind of put this in perspective. This is the Eurozone ETF EZU that I have on the screen here, and what you'll notice is I've circled 4 pullbacks over the last decade since the Great Financial Crisis. Each one of these pullbacks is greater than 25%. In fact, they're all almost 30% or greater, except for the most recent, which is shy of 30%. So they're all over 30 or all over 25%. 4 25% pullbacks in the EZU ETF during the last decade, and yet the S&P never once pulled back more than 25%. So the divergence in terms of overall impact is in terms of overall impact to global slowdown relative to the U.S. is very striking from just this one chart alone. And again, I mean, you can pull up different whether it's the DAX or the CAC or whatever you want to pull up. It might be present a slightly different story. Either way, it's no secret that that Europe and the rest of the world has very much lagged the U.S. in terms of developed economy growth over the last decade. And again, I really attribute this to the stronger dollar and the reality that the U.S. is the issuer of the dollar, and the rest of the world is very dollar dependent. There is a ton of dollar denominated debt that really fuels the global money system, and it's the fact that really is kind of what broke down in 2008 and has never really restored itself, that has made growth in the rest of the world very, very difficult. And I think that's why if I turn on the dollar index here, you can see it's in yellow here. You know what? Let me make that blue, make it a little bit easier to see. And the next thing I'll do is I'll go ahead and invert this. Whoops. Maybe I won't. I'll go ahead and invert this and show that if we invert the dollar, so the dollar index is obviously very heavily weighted in the euro. You'll see a very strong correlation between these two. So an inverse correlation between the dollar, meaning that strong dollar makes it difficult for really the rest of the world to grow, and a weak dollar makes it easier. And maybe you could even say that a weak dollar is the not the cause but the effect of growth as credit impulses push the dollar lower, and we see growth in the rest of the world. And I think that is something that might actually be happening as we see the dollar trend slightly sideways, slightly lower over the last couple weeks here, is kind of an indication that we might be seeing again that those credit impulses, global credit impulses, pushing the dollar down going forward. So yeah, big takeaway there. If you do see the dollar going down, I think that might be an indication that the rest of the world might be taking an opportunity to push higher. But either way, the big issue with the rest of the world is that they are dependent on essentially the dollar to fuel their funding system, and that whole euro dollar market has really broken down over the last decade. And so bringing it back to kind of the theme of this video, I think the bears saw again growth slowing down in global markets, and really kind of weighted that too much heavily in the idea that the U.S. would follow suit, which obviously hasn't panned out yet, and I don't think will for the time to come. And kind of the last reason that I want to talk about, or I should say the last reason that I want to talk about that I think the bears really got wrong, and this is one that is just going to be forever wrong in my mind. I could see a time where the yield curve inverts, and that is a true indication of an oncoming kind of recession or oncoming real economic issues. And I could see a time where the rest of the world slowdown finally impacts the U.S. to a point where we see some major issues as well across the board. However, this one in particular is just constantly wrong, and I see so many people get this wrong, and it's kind of a hobby horse of mine to stump for, if you will, and that is that this growing deficit is some big issue. And I think this is really what separates the U.S. right now from the rest of the world, and in fact is kind of what's keeping the rest of the world afloat. And again, I'm not saying this because I think that there's any American exceptionalism here. It just is the system that we have, a U.S. dollar dominated system where the U.S. dollar is the reserve currency of the world, and that means something, and there are kind of effects because of that, and consequences because of that. And one of those consequences is, if the U.S. were to stop running larger and larger deficits year over year, that would begin to constrict the flow of money into the global economy, not only the U.S. economy, but the global economy as a whole. And what that does is when you constrict that flow of money, the only other place that kind of money can flow from is from a leveraging process, right? It has to be borrowed out and from the banking system. And at this point, the global banking system is just not in a position to leverage up much more. It needs that constant flow of kind of what I would call new real money entering the economy from the U.S. federal fiscal side into the economy as a whole. And that is why, again, I think this is just a completely incorrect reading from many bears that this is some sort of worry that is out in the distance but getting closer and closer every single day. No, this is the one thing that has been very much keeping the global economy afloat, and more importantly, continuing to support the equity markets as a whole here in the U.S. So this is, again, I think anyone who would say, hey, look, this deficit, we're almost at $23 trillion U.S. debt. This is it's finally time that this is going to we're going to reap what we sow, sort of thing. They're entirely wrong, and they really don't have. I mean, I try not to get too extreme in what I say here, but they really have no clue what they're talking about when it comes to the basics of macroeconomics. So this is, as it stands, a supportive, I'll use the term good, but good insofar as supportive of higher equity prices and sustaining a stable economy. So, and it's not and I want to be clear too, it's not a commentary on that this money is being spent well, or that it's being put to the best use for society that it could be put to. That's a different debate for a different day. The point is that this money does enter the economy, and there is it does flow into the economy, and that's really what we're looking for, is that those flows remain going. We're not seeing any contraction of those flows, and we're not seeing then any reliance on a already kind of overburdened debt-laden banking system that really just couldn't take on too much more debt for too longer. So as it stands, I think this is the big miscalculation, and this is really what's kind of kept me bullish even through, say, the end of 2018, now a whole year ago, and into today. Why I really thought that we would continue to push through and see overall relative stability in the U.S. economy, and ultimately push to higher equity prices. So those are the big three things that I think that I've seen, again, just in my observations, that the bears, those who kind of have a bearish tendency, who have either kind of been on the sidelines or just straight up, kind of thinking we should be short this market, that have just gotten absolutely wrong to this point. Now, that being said, there are some risks, and I don't want to kind of paint a picture of things being too rosy. Look, we do have a private debt issue that is way too big in this country and in the globe. Corporate debt continues to expand. That's a big issue. But this is one thing that really kind of separates what I'm trying to do and what I think I see a lot of people who want to jump on this kind of whether it be kind of Minsky style, debt deflation style debate, where they see, hey, look, we've got a debt problem. The thing that I see differently, or the thing that I've tried to, build that's different, is it's not the stock of debt, right? It's not the overall amount of debt. It's how that debt is flowing through the system and where that debt is flowing. It's an issue of confusing is one of the people that I mentioned many times on this channel is mentioned many times, it's a confusion of stocks and flows in the system that is our economy. And so many people get fixated on those stocks. So that is the total amount of debt, but it's really that debt as it flows through the economy that you need to understand, you need to track. That's what it is that you want to see. And as long as those flows are showing positive growth, or at least the flows are supportive of higher equity prices, we want to be long equities, and that's kind of what I've tried to establish over the years here of doing Cannon market analysis here on YouTube, and then also on my Patreon. So that's what we've been trying to develop, and as it stands right now, just in kind of the broadest stroke possible, things still look pretty darn good. Like I said at the start of this video, I do think that in the short run we might see a little bit more selling through the end of this week. Maybe not. I mean, we don't have to have it, but wouldn't surprise me if we drop another 0.5% or so from where we're at right now, and then eventually emerge higher into the end of the year and start pushing higher into the end of the year. So again, I'm making this knowing full well that making this video knowing full well that in the short run we could see a little bit more selling, but I do think that will present an opportunity for markets to push higher. And I think, again, the bears are likely going to be disappointed going forward, and I'm sure many of the same issues will reoccur. Many of the same themes will reoccur over the future weeks and months to come. And so if you see these themes, maybe at some point, especially the global growth and the yield curve inversion issue, they might be a real issue. But we want to weigh all those potential risks with each other and see, okay, is this a real risk here? And of course, with the deficit growing thing, that is not a risk. That is exactly 180 degrees wrong if anyone tells you otherwise. So definitely don't listen to those alarmists there. So that's going to wrap up this update. And if you like what I'm doing here, make sure you check out my Patreon page, patreon.com/CannonMA. Multiple updates each week. I go into a lot more detail in terms of how I determine what those flows are that I was just talking about and how they correlate to markets. Past couple months of updates have been very spot on, and I think from my perspective, quite interesting. So definitely jump in on that, and you'll get the entire backlog of updates that you can take a look at and see kind of how I break things down. So other than that, good trading everyone for the rest of the week, and we'll see you next time. Bye bye.